Thank you for checking out Fieldman, Rolapp Associates Municipal Market Update for the week of October 23rd. This is our 50th posting, and we thank all the people who have viewed this multiple times and sent us comments and things to consider. Everyone that has, we have incorporated that in some way to help make this a better posting. Fieldman, Rolapp Associates is a municipal advisor to government. The Municipal Market Update, or as we often call it, the MMU, that is a recording that we do approximately monthly, and it is an attempt at a very high level to give our clients and other industry professionals an overview of what we're seeing in the municipal market since the last posting. And once again, we're very happy to have our 50th posting here, and thank everybody who's viewed it, and also especially those who have given us feedback, and we encourage you to continue doing so. But now let's get into the data. And our first slide here, this was a slide that we started off trying to make things very simple. And what we started off with was showing the Fed funds rate increases. And look at those green bars, and then go to the far right vertical axis. Those are the Fed rate increases. So if you look at that March 2022, slide over to the right, you get to 25. They increased rates by 0.25. And then you can see May by 0.5. Then 4 straight times of doing 75 basis points, and still they really started tapering off. And so that just gives you some perspective on how much the Fed has done to increase rates. But that yellow line tracks that in a cumulative fashion. And so what you can see there is every time there's been a Fed funds increase, that line has a spike upward. And then you can look at the cumulative effect of those rate increases by looking at that yellow line and then sliding over to the left. And then you can see where we've lined up above the 5% mark there for the Fed funds increase. Now, another thing we wanted to layer in this is a 10-year Treasury. This is an indice that a lot of industry professionals, both in municipal finance and outside, use as a gauge for tracking where interest rates are. And that's what that light blue line is. And I think what you probably notice is with some of the rate increases as they went up, when I say rate increase, the Fed funds rate increases, that really trended upward. That trend really continued until about November of 22. And if you recall, in November of 22, there was a pretty significant speech by the Fed chair. And I think one of the takeaways from that was the Fed still needs to increase rates, but they are not likely to do so as dramatically as they had previously. And if you look back at that, November 22, you had 4 straight 75 basis point increases. And so I think the market just calmed down a bit on the rate increases. And you still see rate increases. I think you see 1, 2, 3, 4, 5 rate increases since then, but they aren't to the tune of the 75 basis points that we had grown accustomed to over the period where we had 4 straight. So a lot to unpack with this slide, but hopefully what it tries to tell is a story of why rates have changed the way they have. That light blue line, one of the things you're probably noticing is even though we don't have a lot of Fed fund rate increases, or not as dramatic as they were previously, we're still seeing a trend upward in interest rates. And we're seeing mortgage rates much higher. And you're hearing a lot of the news commentators say things like the rise in the 10-year Treasury and others rates is kind of doing the Fed's work for them. I think the Fed would argue their increases have helped impact those things, and they're seeing the effect of their rate increases over the last several years. Anyway, like I said, a lot to unpack on this slide, but hopefully this helps tell the story of what we're seeing with both Fed action and also the real rate increases. Now, this is a much simpler chart, but you can see years there at the horizontal axis and interest rate on the vertical axis. I've mentioned on the MMU multiple times, we really started seeing an increase in rates at the very turn of the calendar in 2022. And that's that blue line with the green dots on it. And, a lot of things that look, relatively flat. You don't see the long end is not too high. But then, and this is the U.S. Treasury yield curve. And then what you hopefully notice is just how much rates have gone up since then. So now go to that October 19th, 2023 line. That's that light green line. I think a few things you should notice on that. One is rates are a lot higher. Two is that that yield curve doesn't have that traditional sloping upward over time. We have an inverted yield curve here. So investors charge a higher interest rate for US Treasuries to lend for 1 year than they do 2-year, 3-year, 4-year, 5-year, even 7 years out there. And then it looks like it gets really close there after year 10. But that is, you can go on Google, you can look a number of places what an inverted yield curve might mean for things going forward. But that is a market that we've been working through, is where you have a yield curve that, like I said, has a higher interest rate in the short end than it does on the midterm, which is much different from where we were in that 1/3/2022 point in time. Now, I want to give you some perspective of how the 30-year MMD has changed over time. 30-year, that's a term of 30 years, MMD, municipal market data, and this is for the AAA. And so if you look at that October 3rd, 2022, approximately, or a little more than a year ago, the 30-year MMD was at 3.84. This is after having gone up in September by 43 basis points. And then you can see that November it went up as well, but December, this is right after that Fed speech that I had mentioned on a few slides ago, the 30-year went down. Then January comes along, goes up just a little bit. February goes down. Let's just drop all the way down here to last September and October. So these would be the increases in August and September. And you can see very significant rate increases over that point in time. And so that's one of the things we've all been dealing with, is just seeing that long-term increase. One of the things I've talked about in a previous slide was the inverted yield curve. I think one of the things we're seeing now are the longer-term rates going up. And so some of this is that not every maturity has gone up by this much, but certainly the 30-year has. On our next slide, what we try to do here is put all this in perspective. Once again, interest rates on the vertical yield curve, years or terms on the horizontal line. And what we're showing there is the green bars represent the range of interest rates if you go back to 2005. That light green bar represents, or line, I should say, represents the MMD for each one of those maturities on 10/19/2023. You probably noticed, especially in the front end, we're elevated and we're close to those highs. But that drops off and still high, but not about much more closer to the average than being right up against the top there like we are in year one. And finally, you work your way all the way out, and you can see there your 30 at 407. Something I want to point your attention to. You see that 30-year at 4.07? I just showed you where the 30-year was just a few weeks ago, and that's at 4.34. So the 30-year on October 2nd was 4.34, and now it's at, or as of last Thursday, it's at 4.07. So you can see quite a significant change just in a relatively short period of time there. Now, what is driving a lot of this? You've seen these, let me take a step before I try to explain things here, is what these green and yellow bars represent. Green means money flowing into the municipal bond funds. Yellow means money flowing out. Now, why is this important? Generally, the municipal bond funds are the largest purchaser of municipal bonds. And a few things that are jumping out at you probably is that green, or I'm sorry, yellow spike downward in March of 20. That was when we discovered COVID, or we recognized that we're shutting down businesses and schools, and money flowed out of municipal bond funds. Then the Fed took some pretty dramatic action and dropped rates near zero. And then that's when money started flowing back in a pretty consistent fashion until you get to that January of 22, which, as I told you, to me, that was a very significant time, and why I always kind of reference that point in time, because that was when I think we stopped hearing about transitory inflation. We started hearing about inflation, and then that following March is when the Fed started increasing rates. But now, if you go back and look at January of 22 to September of 23, you can just see a general outflow with a few exceptions of the municipal bond funds. And so that means there's less investors here to buy the bonds, which is a decline in demand. Now, to some degree, that's offset because we don't have that much in volume. And if you look at the 2022 line and 2021 line, you can, well, at least 2021 is quite a bit higher on a weekly average than we're seeing recently. Now, that week of October 16th is a bit of an exception there. But you can see all these other, and there's these big gaps when there is a lot of activity. But you can see generally we're below those lines of when interest rates were very low. And so what you're seeing here, I think, is less demand, but there's also a lot less supply. If we had less demand, but we also had that historical amount of supply, I think you would have seen rates go up quite a bit more. But fortunately here, we are not seeing that effect. Now that we put a lot of data on this slide just to kind of wrap everything up here. Monthly bond issuance volume, I think this just really highlights the decline that we've seen in the last 2 years and really the inflated volume we saw in 20 and 21. So 22, 23, a real decline in issuance, 20 and 21, real high amount of issuance. Now, let's go over to the right here, negotiated, competitive versus private. This chart just tries to give you some perspective on how deals are getting done. One of the things I think we should all watch is the private placements, and that's direct investors. One of the things that we've seen is the regional banks struggled at the late first quarter of 23. I think you've heard some of them were taken over or somehow there's a remedy to make changes at those banks. But what we're seeing here, the reason why I think mentioning those are so important is that they have historically been a significant buyer of the private placements. They are the banks that were doing that in a lot of cases. And I think you're likely to see a real decline in that going forward. Then you have taxable versus tax exempt here at the bottom left. In 20 and 21, taxable rates got so low that we were doing refundings on a taxable basis of bonds that were originally considered tax exempt. And I think that's some of what's driving this yellow greenish bar. And then certainly that is not the case now. And so you are not seeing nearly as much of that as you had previously. Then on this chart to the far right here, you're seeing refunding versus new money. Obviously, what you're probably noticing is these blue bars are a lot less, and that is likely a direct result of rates being higher, just not nearly as much refundings going on in the marketplace. Finally, we wanted to highlight some of the economic data that will be coming out over the next few weeks before we post another MMU, and you can see these items listed there. Our last slide just highlights the municipal advisor representatives that Fieldman, Rolapp Associates has. I encourage you to reach out to any one of these individuals for additional information. But we all thank you for your time. We appreciate you checking this out and encourage you to reach out to us if you have any additions, ways that we can present the information that's more helpful. And until November, take care.